Hello everyone. I am your professor, Professor Harsirat Kaur, and welcome to the module number 5, Cost of Capital. So in the previous module, we have covered the topics about capitalization, different types of capital, how capitalization is important in terms of having strategic decisions in the company. So capitalization concept, we have covered that there are two types of capitals, working capital, fixed capital. So now in this module, we will talk about cost of capital. Like there is always a cost associated with the capital. So also we underlined the meaning of capital, that the investment that we do in terms of money, in terms of assets, everything that we do in terms of investment is called capital in the company. So so the cost of capital is the topic of today's session that we are going to study. So we will learn different aspects of cost of capital, what are the different types of cost of capital that we are going to calculate, and how it reflects into the decisions of the company. So for example, capital is a very essential part in companies' decisions, in companies' everything, I think so, because all the financial activities are being done in the company, whether investment activities, whether investment financing or day-to-day activities, everything happens with the help of capital, right? So without capital, we cannot do anything in the company. So capital is a very integral and essential part to study, and the cost of capital reflects that what is the cost which is associated with certain financial activities that the company is doing. And every company expects productivity and profits, so we have to see what is the cost of investment we are doing in the company in order to get the required results, required return of investment, return rate of return. Okay, so let's dive in. So cost of capital, as I was explaining to you, that it is a very integral part of investment decision. So where we have to invest, that is the cost of capital. Whether we have to uh, raise capital by taking decisions on the basis of equity, by issuing shares, or by taking loans, long-term loans or short-term loans by debt. Okay, so there are different methods of raising capital in the company that we have discussed in the previous sessions as well. So cost of capital is a measure which tells us about that what is the required rate of return which is expected while investing in a certain project. So what is the earning capacity of the firm that is being reflected by the cost of capital. Okay, so how much money we have invested in the project and how much return we are getting. So we are using different sources of finance. Finance managers take very careful decisions about the cost of capital, because cost of capital determines the present value of the future cash flows and the projects which are associated with that. So the meaning of cost of capital is that the it determines that how much is our investment and what the productivity that we are getting. Okay, so cost of capital is the required rate of return on our investment which belongs to equity, debt and retained earnings. If the firm, for example, if the cost of capital, the amount of money that we have invested is not earning return at expected rate, then what will happen? The market value of its shares will decrease. It will lose its attractiveness to the shareholders and also to the investors, because investors look cost of capital, and investor looks on the financial statements in order to make decisions in the company, right? So it overall it affects the wealth of the shareholders. So there are different definitions of cost of capital. So from one perspective, it is the rate of return the firm expects or it is required from the investment that they have done in order to increase the value of the firm in the marketplace, because the more return you get, the more attractive your firm would become, and the more investors would invest in your company, the more equity would you have, the more capital stock do you have. So in this way, the more market value of your firm would be. So cost of capital is a minimum rate or required rate of earnings or a cutoff rate of capital expenditures. So these are the different definitions of cost of capital. So cost of capital, you can see here assumption of cost of capital, that is based on certain assumptions. When we calculate cost of capital, it is to be considered that there are three basic concepts. Number one, it is not as such a cost, of course, because it is a hurdle rate, it is a required rate of return. And the cost of capital is measured with three types of risk: financial risk, business risk, and the riskless cost of particular type of finance, and K is the cost of capital. So there are four different types of costs which are associated with the cost of capital. So there are different types of costs which are related with the capitals. So let's see. Hello everyone. Welcome back to the session. So in today's session, we will talk about different types of cost of capital. So in the previous session, as I was explaining you the definition of cost of capital, but in today's session, we will talk about different types of cost of capital. So there are 6 different types of cost of capital, and after understanding the meanings of cost of capital, we will calculate the cost of capital, average cost of capital, which includes the different specific parts which accounts to the cost of capital and their weighted averages. So let's talk about explicit and implicit cost. So what is explicit cost of capital? So explicit cost of capital is also called internal rate of return of the opportunity, financial opportunity. So as we know that the different firms raise funds through equity and debt. So the funds can be raised in the company via equity, preference shares, and the debentures, or through the different assets. So all these activities comprises some cost associated with them. So for example, when the company raise funds through these sources of finance, then there are some cashbacks which are associated with it. For example, maybe it's the repayments of the interest, it could be dividends, right? So the amount of money that the firm pays back, that is called the explicit cost. So if the company is raising funds from the non-interest bearing sources of finance, then they have zero explicit cost. On the other hand side, the implicit cost is the opposite. It's also called the opportunity cost. It is the investment opportunity for the firm. It's like it's the it is the cost. It's like an opportunity cost for the company regarding the projects which are under consideration. If the firm accept this project, then they would have this much cost associated with it. So it's like that, okay? So explicit cost always arise when the funds are raised. Okay. So from this equation, you can see that this is a formula for calculating the net amount of funds received by the firm at time 0. So you can see here that how the explicit cost is being shown over an period of time. The funds were provided, and you can see that it shows the outflows during n number of times during that period. Okay, so here if you can see that it says that from this equation we can find out the internal rate of return of the cash flow of the financial opportunity. So these are the repayments that are being done. So this is an explicit cost which is associated with every repayment. Okay, so next we will talk about average or marginal cost. So average cost of capital. What is average cost of capital? So average cost of capital is the cost of capital which is a weighted average cost. Okay, so we will weigh each element or each source of raising finance or funds of the company. So we know that the funds or financing of a company is being done through equity, debt, or retained earnings. So but the weighted average means the proportionate weight that we are calculating in terms of equity, debt, or retained earnings. So that is called weighted average cost of all the different kinds of financial entities like equity, debt, or retained earnings. On the other hand side, marginal cost. So marginal cost is when, despite being equity, debt, or retained earnings, any other additional cost of capital is concerned or the company goes for raising finances in the company, that one extra step that the company do despite all these elements, this is called marginal cost. Okay, historic cost versus future cost. So when a company has to decide the cost of the project, so historical cost is the cost which is a cost which already have been incurred with the previous project. So it is a kind of benchmark or actual cost of the previous project. Okay. However, future cost is how much that project would cost in the future. It's like the forecasted cost. Okay. It's expected cost of financing which is associated with a particular project. Another one is about specific and combined cost. So specific cost, what is a specific cost? Specific cost is the specific cost of equity, specific cost of debt, or specific cost of retained earnings and loans. So when the specific cost of each source of capital is being calculated, that we are going to calculate in the further slides, these costs are called specific cost of capital. However, combined cost of capital is the overall cost of capital. So we calculate the overall cost of all the sources of capital. So that is called composite cost of capital or combined cost of capital. It tells us about the total finance of the company. So what are the importance of cost of capital? So for example, cost of capital is a very integral part in terms of financial management in order to decide, in order to take financial decisions in the company. Because if we know how much would we have to, for example, if we have to undergo any project, that what would be the cost for undergoing that project and what would be the return that we are going to get, whether it is profitable or not. So it is very important to know what is the cost of capital, how many repayments we have to we have to give, or how many interest, what is the interest rate, what should be the dividends that we have to pay to the investors, right? And the timely payments. So all the financial decisions are based upon that. So it is very important when we have to budget the capital budgeting decisions, when we have to define the structure of different kinds of long-term securities, whether we have to raise funds via equity or via debt or any other source of finance. So these kind of decisions are being based on cost of capital. However, it tells the information to the investors as well in order to figure it out whether the market shares are profitable or not, what is the earning capacity of the security, market value of the share. So in this way we can see that it forms a major part in the financial management of a company. So the next step is about computation of cost of capital. Then how can we calculate the cost of capital? So there are two different methods, two important parts in which we calculate the cost of capital. First of all, we measure the specific cost, cost of equity, cost of debt, cost of preference share or retained earnings. So we specifically we calculate the cost of each source of finance and then we add it. Then we measure the overall cost of capital. So first of all, I will talk about the cost of equity that we are going to discuss in today's slide. So what is the cost of equity? So the cost of equity is the cost which means that, for example, it is the cost which is associated with the equity financed part of the company. So it is a required return that the investors that the company pays to the investors, because when the investor invest in a equity of the company, then the company benefit the investor in two parts, either the stock appreciation or dividends. Okay, so there is some cost which the company is obliged to give back to the investors, because also there is a risk factor which is associated with the investment. So this is called the cost of equity and the equity financed part of the company. So cost of equity capital is represented by KE. So it is defined as the minimum rate of return that the firm must earn on equity financed portion of an investment project in order to leave unchanged the market price of shares. Okay, so this is one of the model which is called dividend price approach, in which we calculate the expected dividend which will maintain the present market price of the equity shares. So it is the cost of capital, and in this we find out the expected rate of expected dividend. So this is one method, the most commonly used method. So in this formula, we will calculate the cost of equity when dividends are involved, and this method is called dividend price plus growth approach. So in which when the dividends are growing, then we can calculate by using this formula, or when the dividends are not growing, like there is no growth involved, so we use the previous formula. So as you see here, the KE represents the cost of equity capital. However, D represents the dividend per share. So I will explain you how to use this formula according to the following example. So G is the growth in expected dividend, which is expected to be, and NP represents the net proceeds of equity share. So what's the net value? Okay, so for example, here you can see a company plans to issue 1,000 new shares of rupees 100 each at par. So the face value of one share out of 1,000 new shares that they are going to issue values 100 rupees, okay, at par, at its face value, which is issued at the point when the securities are being issued, right? The flotation costs are expected to be 4% of the share price. So there is a flotation cost which is associated with the share price. Okay, so what we would do, so here you can see the NP, net proceeds of an equity share, here is 100. So 100 minus flotation 4. Okay, so the company pays a dividend of rupees 12 per share initially. So how much is the dividend here is 12, and the growth of the dividend is expected to be 5%. So the small g is 5 here. Compute the cost of the cost of new issue of equity shares. So how can we calculate here? So you can see here that how the different entities that were given in the statement are being presented over here. So here you can see that the cost of equity, that the cost of new issue of the share, each share would be this. Next method is earning price approach. So this determines the market price of the shares. So where E represents the earning per share. the rest of the things would remain the same. However, the next method is realized yield approach. So in the realized yield approach, we calculate the cost of equity capital on the basis of return realized by the investor in a company on their equity capital, that how much yield they will get over their investment. So the next is cost of debt. So cost of debt is the rate of return that the company pays to its lenders or whatever debt borrowings that they have in the company. So the amount of interest that the company pays to its lenders or to the sources of finance from where they have borrowed the money, the cost which is associated with that is called cost of debt. So as we were talking about that the company has different sources of finance, like they finance through debt and equity, preference shares, bonds, debentures, many sources of finance. So debt is also one of the source of finance through which the company raised the funds. So there is a cost which is associated with it in terms of um, interest. So the cost of debt, which is calculated before the tax and after the tax. So there are two stages. So after the tax, the cost of debt is calculated because it helps in tax deduction. However, the formula is given here. When the debt is issued at face value, then the cost of debt is calculated by 1 minus t into r, where t is the tax rate and r is the interest rate at the debenture. So here is the formula that you can see here before tax, pre-tax and post-tax. However, if we move forward, when the debt is issued at premium or discount, then we can calculate over here. The only change is that tax rate remains the same, 1 minus t, and I is the annual interest payable that we are going to pay upon divided by n. Also, the cost of perpetual debt and redeemable debt is calculated by using this formula. Okay, so the next is cost of preference share capital. So this is another source of finance that we have discussed, which are preference shared. In the preference share, there are fixed amount of annual dividends that are being paid to the shareholders. So the cost of preference share capital is the annual preference share dividend by the net proceeds from the sale of preference shares. So the formula is KP is equals to TP over NP. So how much fixed preference dividend paid to the shareholders upon NP, net proceeds of an equity. So here you can see in an example, the formula is given here that how we call the cost of premium. So if we see here, there is a condition given that XYZ Limited Company issues 20,000 preference shares, 8% at the percentage of 8%, okay, of rupees 100 each. The cost of issue is 20 rupees 2 per share, okay. So the cost is given, the price is given, and the number of shares are given. So we have to find out the cost of preference share, KP, we have to find out at par when it is issued at face value, at premium, and debenture. Okay, so the next is cost of retained earnings. So we have covered the cost of debt, cost of equity, cost of preference shares. Now also retained earnings. Retained earnings are the earnings which are the source of finance in the company for investment purposes, right? So whatever left in the company after paying the liabilities of the company, whatever left is retained earnings. So retained earnings can be used for the further development of the business and can be invested as well, right, in the company. So how could we calculate it? The cost of retained earnings would be calculated when the cost of equity is multiplied by the tax rate is multiplied with the brokerage cost, okay. So cost of retained earnings is the same cost of an equivalent fully subscribed issuing of additional shares, which is measured by cost of equity. So here you can see the example that how we can apply earnings. So now we know how to calculate the cost of debt. Here is the formula. So cost calculate. Okay, I will explain you better through this example. Let's see. Wait, we will calculate the total value overall